Hey there, Joe DeSanto here. Thanks for joining me as always. In this video, I'm going to do another Q&A video here talking about some tips on how to reduce taxes on real estate income through all legitimate means is the last bit of the question. So to answer this question, there's a few things you can consider for reducing taxes on, real estate gains and also investment income. Number one, if you are selling a property and you're making a gain and you're willing to reinvest in another property, you can do what's called a 1031 exchange. It's where you take the gains slash proceeds of one real estate investment and you roll them into another real estate investment, and you basically defer any tax that is owed. Now, the trick of this, though, it's a little tricky because you have to essentially go into a larger real estate investment, overall, some few details there, and then also you have to get the property, you have to identify the property within a certain period of time, the one that you're going to buy, the exchange, I think within 45 days of the close of the sale, and then you actually have to close on that property within 180 days. That is a tricky thing to do often, so you may or may not be able to pull it off, but it's something to consider. Generally, of course, with the real estate, the main way that you end up saving on taxes and get some tax-free income is to use depreciation. And so you own a property, you have income and expense every year, but you also get to depreciate that property as a capital asset and over a certain period of time. So for residential real estate, that's 27 and a half years. For commercial real estate, that's 39 years. So you take the value of the improvement or the structure, you divide by those time periods, and every year you get a depreciation expense for the building. Now that in and of itself is a tax-saving tool, and that's pretty standard op. But something else you can do in the area of depreciation is what's called a cost segregation study, which can create for you accelerated depreciation. Now, a cost segregation study is more often employed in a larger real estate transaction and more probably commonly in commercial real estate. Though if it were an apartment building or so, you could do that. Like I got one done and it was about $10,000. However, what it does is the truth of real estate depreciation is that the building itself, say for commercial real estate, it's a 39-year depreciation. But stuff inside the building, like the carpeting, like the cabinetry, the millwork, a variety of things inside the building potentially can depreciate on a faster schedule, thereby giving you more front-loaded depreciation. Also, you get a certain amount of bonus depreciation in year one. So you could, even though some of those things might be in a 5, 10, 15 year schedule while the building's on 39 and a half, you can bonus depreciate some of the stuff in those quicker depreciation schedules, I think up to about $1 million. So you can get a huge amount of depreciation in a large deal by doing a cost segregation study. So that's another way. It's more advanced, but definitely can save you a lot of money. Another thing you can do is if you qualify to be a real estate professional, this is someone I think that spends more than 750 hours per year working on real estate endeavors, whether that be selling real estate, so a realtor would be this anyway, or flipping properties or managing real estate or whatever. You now can take losses from your passive real estate and have it offset your regular income. Normally, if real estate investments are considered passive income, and so those investments and those capital gains are in the passive category, so they can't offset your regular income. They can, however, offset other passive gains. So losses in a real estate transaction could offset gains in stocks and vice versa in a given year. But if you want to be able to take advantage, say, of some huge amount of accelerated depreciation off of your regular income, if you qualified as a real estate professional, you would be able to do that. So that's yet another way. Now, I also like to say, mostly we're talking about investment property here, but I do consider your primary residence a real estate investment. I look at it as though you are basically a renter in a property that you also happen to own as an investor, right? Because you would be renting anyway. The only reason I bring this up is because I like to say to people who don't own property yet or don't own their home, your residence as a real estate investment is a great one because you get great tax advantages. You can take a deduction for the mortgage interest along the way. You can take a deduction for the taxes. Those have been capped in recent years, so the benefit there is a little bit less than it has been historically. But don't forget, as a single person, you get $250,000 of free capital gains on the sale of your primary residence, and a married couple gets $500,000 of free capital gains on the primary residence. So it's one of the most tax advantaged real estate purchases you can make. I think even more so than a regular rental real estate, in a basic sense. So those are some tax ideas around real estate. Hopefully that was helpful. I'll see you in the next one. Bye.